afternoon. It's Friday, January 27th, almost the end of the first month of what's shaping up to be a very different year than 2022. I'm Dave Weisberger, CEO of CoinRoutes, and let's talk about what's been going on in the world of crypto. Well, the market itself did something that I kind of hoped it would do. If you remember last week, I was very bullish. I am still very bullish in the long run. Last week, as I was taping, the market was rallying. It was somewhere around 21,000, cresting 22,000 an hour later. And then the next day got to 23,000. And here we are 7 days later, and that's exactly where it is. Market is traded from 22.5 to 23.5 over the course of the week, which is a very healthy consolidation pattern after a gain of, depending on how one measures it, somewhere around 30 or 40% from the bottom. Now, the fact is there's lots of reasons why this is the case, and I don't want to belabor them. I talked about them last week. What matters is that volumes are actually starting to tick up. Interest is starting to tick up. We at CoinRoutes are even seeing significant client interest in reestablishing trading operations that were decimated by Sam Bankman-Fried's theft of their assets. And all in all, we're starting to see even more signs of green shoots of spring in crypto. That said, it's still early. The price action is healthy, however, and this sort of sideways chop is not a bad thing after we've had these sorts of gains, particularly when we see coins like Polygon having really nice days after news is announced, and it's showing the market is kind of still digesting what's going on. So from a market perspective, things seem relatively healthy. There still are people who lost money in FTX who are not exposed to crypto that need to become exposed. The percentage of long-term holders is still ridiculously high. We saw this past week, during the week, Bitcoin's hash rate hit an all-time high, and miners are going to get drubbed again because they're talking about yet another difficulty adjustment to the upside. So the reality is the internals underneath the crypto market look good. But the real question that's going to happen over the course of this year is something that came up a lot this week. I attended several conferences, many of them with TradFi people this week in Miami that season. And I did a talk where we discussed demystifying crypto. And one of the points that I kept getting asked was, well, isn't this whole crypto thing really, really, difficult for people? Can they not understand it? How do you understand it, etc.? And particularly when I made the comment that a system that we have needs to embrace decentralized options, including self-custody, that created some horror from people because they said, well, wait a minute, I need to have, I don't want to do this myself. I'm afraid I'm going to lose it. And there's always articles about how Bitcoin gets lost if you self-custody, if you don't know what you're doing, or if you don't set up proper instructions for people who might inherit from you, etc. So the fact of the matter is, my answer is simple. There needs to be choice. Choice for people who want to do it themselves, choice for people who want to delegate to a trusted third party, a BNY Mellon, a Fidelity, or somebody else, or choice for people who want to use crypto native firms to hold on to their assets. But that said, the industry itself needs to adapt, and the regulation needs to adapt to that reality. So to that end, we had a really interesting juxtaposition this week. Earlier in the week, we had a brilliant speech that I advise everybody to look at from Commissioner Hester Peirce. It was actually on the 20th. She delivered it. It's on the SEC website, and it's the most recent one she gave, so you can find it pretty quickly. And it was brilliant. And it talked about the evolution of technology of computer dating all the way through to blockchain. It talked about the fact that the industry needs to own our issues and work and do things better in terms of understanding and working with clients, eliminating conflicts of interest, controlling and identifying risks, and paying attention to the risks. And I've talked about all this many times before, but I thought she said it very well. She also specifically talked about the regulators and said a couple of really interesting lines. My two favorites were that this is a teachable moment for regulation, and the industry and that the regulators should foster an environment where good things flourish and bad things perish. Sounds obvious, except for the fact that the regulators have not been doing that. They've not been even their regulatory actions have not gone against companies that have caused investor harms. In fact, by finding BlockFi, they actually harmed investors as BlockFi tipped into bankruptcy, and the SEC is ahead of them. So that's a bit of a problem. She also talks about that the current approach using regulation by enforcement is, and I quote, the opposite of a rational regulatory framework. So it's really interesting to listen to all of this. She did lay out 5 principles that are worth repeating that really matter from a regulatory perspective, because I agree with all of them. First, there needs to be nuanced between the products and between the technologies. The same regulation for DeFi may not work for centralized finance, and the same regulation for Bitcoin might not work for other protocols. We need to understand that. Second, we need to be important to avoid chilling innovation. Innovation is the backbone of this country. It's what creates the most jobs. We shouldn't be chilling that. Third, regulation is not the same as enforcement. It should be done by making rules that create clarity, and the legislators and the regulators need to own that. Fourth, scaring traditional firms, firms that have cultures that understand investor protection, understand anti manipulation, understand not doing false and misleading advertisements. Those sorts of firms should not be told, don't go into crypto. They should be told, go into it intelligently. The fifth one is to preserve decentralization. That decentralization is a vital idea, and it's something that we should embrace and not scare away. Now, I said this was a juxtaposition because today, multiple officials in the Biden administration came out and said some things, some of which are okay, but some of which directly contravene this. They said, evidently, Congress should expand regulators' powers to prevent misuse of customer assets and and mitigate conflicts of interest. Now, on that, I completely agree. Hester, I'm sure, agrees. I think it's very, very clear. But they also talked about what they should not do. They should not create rules that would green light mainstream institutions like pension funds diving into cryptocurrency markets. Basically, these people are trying to choose winners and losers. They have a belief in what they want to happen, and that belief is they want the current system to continue. They don't want this disruptive technology to flourish, and so therefore they don't want people to invest in it. That's very telling, in my opinion, and very wrong. Hopefully, the administration will understand and say, okay, we want to mitigate and ring fence risk in the system. And that is true. We'll see what they really meant by this as we go on. Within a backdrop of a strengthening market and strengthening internals, I guess we'll see how this all bears out. It'll be really fascinating over the next few months to see what comes out of DC, in particular when the House starts holding hearings and has both the SEC commissioner and actually people that know what they're talking about come testify, as opposed to the farce that the Senate did, where they had people that really were superfluous to the industry or on the periphery at best. In any case, let's leave it on the hopeful note that Commissioner Peirce's view will start to gain more adoption, because that's something I would like to see happen. Stay safe out there. Have a great weekend, and we'll talk to you next week.